Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Distribution Solutions Group Inc. quarterly report. Distribution Solutions Group Inc. offers a diverse range of businesses and services across various markets. The company's four segments provide the following solutions. Lawson distributes specialty products and services to industrial, commercial, institutional, and government MRO marketplaces. Gexpro Services offers supply chain management solutions, including VMI, kitting, global logistics management, manufacturing localization, value engineering, quality assurance, and more to various industries such as renewables, industrial power, consumer goods, technology, transportation, and aerospace and defense. TestEquity distributes test and measurement equipment, industrial and electronic production supplies, vendor-managed inventory programs, converting, fabrication, and adhesive solutions to industries like aerospace and defense, wireless and communication, semiconductors, industrial electronics, automotive and electronics manufacturing. Canada Branch Division provides industrial MRO supplies, safety products, fasteners, power tools, and related value-add services to the Canadian MRO market. The company operates globally with presence in the United States, Canada, Europe, Pacific Rim, Latin America, and internationally. Distribution Solutions Group, Inc. DSGR, has seen its stock price drop by 27.61% in the past year due to a combination of factors. Key contributors include missed earnings expectations, margin pressures, and a cautious outlook amidst macroeconomic uncertainties. The company's quarterly earnings reports have been mixed, with some exceeding analyst estimates but others falling short. The Q4 2024 report saw a stock decline despite beating EPS and revenue forecasts, while the Cone 2025 report resulted in a significant pre-market drop due to revenue missing expectations. Persistent macroeconomic uncertainty has also weighed on the company's performance, with the CEO citing softness in the U.S. manufacturing sector and increased employee-related costs as factors pushing margins below 10%. The integration of new acquisitions has contributed to margin compression, while strategic investments have added to operational cost pressures. Overall, the combination of these quarterly financial results and broader economic concerns has collectively contributed to DSGR's significant stock price decline over the past year. The primary drivers of revenue growth or decline for a company can be attributed to several key factors. On the growth side, geographic expansion, industry diversification, and service offerings have contributed significantly. Market penetration through strategic locations has also played a crucial role. Acquisitions in 2024 have further boosted revenue, while organic growth and increased sales to key customers have also been important drivers. On the decline side, supply chain disruptions caused by inflation and increased tariffs have had a negative impact on revenue. These disruptions have likely affected the company's ability to deliver products and services efficiently, leading to a decline in revenue. Net income and profit margins. A shift in performance. The financial performance of a company has undergone significant changes between Q3 2024 and Q3 2025. Net income plummeted by $15,469, minus 71.1%, in the third quarter of 2025 compared to the same period last year, dropping from $21,921 to $6,452. However, on a year-to-date basis, net income increased by minus $3,877, minus 21%, rising from $18,593 to $14,716. Profit margins also experienced fluctuations. The gross profit margin decreased from 33.8% in Q3 2024 to 32.9% in Q3 2025, while the operating income margin rose from 4% to 4.5%. On a year-to-date basis, both gross and operating income margins declined. The reasons behind these changes are multifaceted. Decreased revenue or increased expenses likely contributed to the decline in net income. Additionally, changes in operating activities, such as depreciation and amortization, and investing activities, including business acquisitions and equipment purchases, may have also played a role. The company's financial performance indicates a significant improvement in its ability to generate cash from operations. The data shows that the company has transitioned from generating a modest amount of positive operating cash flow in 2024, $10,736, to a substantial increase in 2025, $66,906. This upward trend is a clear indication that the company's financial health is improving, and it is now capable of producing sufficient cash to meet its operational needs. The company's debt level and interest expenses have undergone significant changes over the past year. Regarding debt levels, there is a notable decrease from $739.9 million to $665.5 million as of page 30. However, by September 2025, the outstanding borrowings under the amended credit agreement had increased to $711.6 million, page 57. This indicates that while the company's overall debt level has decreased in some instances, it has also seen an increase in other periods. As for interest expenses, there are conflicting statements within the financial summary. On one hand, pages 45 and 49 indicate a decrease in interest expense from $15,160 to $13,955, 2.7% of revenue, and a reduction of $1.2 million, minus 7.9%, respectively. Conversely, page 51 states an increase of $2.6 million in interest expenses. This discrepancy highlights the complexity of the company's financial situation. In summary, while there are mixed signals regarding interest expenses, the overall debt level has seen significant fluctuations over the past year. The company's financial performance varied across regions and segments. The Pacific Rim region and Latin America region showed improvement, while no specific region was mentioned as performing poorly. In terms of segments, TestEquity and Gexpro Services performed well, with significant increases in operating income and revenue. Lawson's segment also saw a notable increase in operating income, but only a small rise in revenue. The Canada Branch Division initially experienced a decline in revenue before rebounding later on. However, some segments struggled. The gross profit margin decreased due to lower margin projects, and the test and measurement business suffered from reduced margins. Electronic production supplies and value-added services also saw a significant drop in revenue. Management is optimistic about the company's outlook, citing several key strategies for future growth. In the short term, they plan to invest in initiatives that will drive long-term growth while managing debt and maintaining relationships with lenders. In terms of organic growth, management intends to explore new opportunities, increase productivity, expand products sold to existing customers, attract new ones, and invest in e-commerce and digital platforms. They also plan to actively pursue acquisition opportunities that are complementary to their businesses and financially accretive. Management expects revenue growth in key vertical markets, including renewable energy, aerospace and defense, and industrial power. They anticipate adjusted EBITDA to increase due to higher organic revenue, gross profit management, and expense leverage. Overall, the company is positioning itself for long-term success through a combination of organic growth initiatives and strategic acquisitions. DSG has made significant investments through acquisitions to enhance its business operations. The company's most notable acquisition is Conrays Test Equipment, valued at $17 million and completed on November 18, 2024. Additionally, DSG acquired Source Atlantic to expand its presence in the Canadian market. These strategic moves demonstrate the company's commitment to growth and expansion. The company's financial summary reveals a notable trend in its capital management strategy. Specifically, the company has opted to repurchase its own shares rather than distributing dividends to shareholders. This decision is reflected in the company's financial statements, as highlighted on page 32 and further detailed on page 58. By buying back shares, the company aims to increase shareholder value through a more direct means of wealth creation. There are valid concerns regarding inventory buildup and supply chain disruptions. Rising supplier costs due to inflation and tariffs have led to increased transportation and labor costs, resulting in price increases for companies. Furthermore, existing inventory levels are substantial, with a notable $28,267,000 in inventory buildup. These issues indicate potential vulnerabilities in the supply chain that require attention and mitigation strategies to prevent future disruptions. That concludes the financial summary for Distribution Solutions Group Inc. Feel free to comment below, and I will be happy to answer them when possible.